Market Master for the morning, Prabodh Agrawal, President and Head of Research at IIFL Institutional Equities. Good morning, Prabodh. Good to have you with us. First up, a word on TCS and what you will make of the IT pack itself. Do you have a buy on TCS? And what is the overall weight of IT after listening to the TCS management?
Yes, the TCS results has been analyzed well. Basically the results are below expectations. In fact, TCS has been having, a few bad quarters. So consecutive 4-5 quarters have been bad for TCS. But overall, see, IT pack, we are positive. We believe that the fourth quarter results for, most IT companies are bad. But it is that, many companies had client-specific issues or they had cross-currency headwinds, etc. But that should not be a recurring thing, and FY16 should be a much better year. So overall, we believe that the revenue growth should be strong in FY16. EBITDA margin should hold up. And the biggest positive for IT sector could be the potential rupee depreciation. I believe the rupee could depreciate by 3 to 4% as we go ahead. And that will provide a big tailwind for IT companies. So, as a sector as a whole, that's one of the non-consensus calls that we have, where we are bullish on the sector.
Okay. Bullish on the IT sector. Prabodh, hi, good morning. You are bullish on the markets as well. I was going through your note where you say that the Indian markets are not expensive given a 5 to 10 year growth story. Just take us through what the slightly more near-term observation is, say from now for the next 1 year. What could be the positive triggers and what could be the market growth?
Yeah. See, the key thing, while there are a lot of extraneous factors which are at the top of many investors' mind and that continues to have an impact on, day-to-day kind of price movements. But I believe the key thing for the Indian market over the next year would be domestic factors like earnings pickup, some clear direction on macro indicators, some indication on the passage of key legislations. I guess these are the things which will provide direction in the 6 to 12 months. And we believe that, all these parameters would sort of gradually improve. Now, if you take earnings, last year was probably the worst year in the last 10 years for corporate earnings. Net profit growth was hit a decadal low. Revenue growth hit a decadal low. Even the EBITDA and the PAT margins were at a significantly lower level last year. But starting first quarter, we expect, improvements to start. Now, the first quarter headline numbers may suggest that things are not really picking up or the overall Nifty earnings may be in a low single digit. But actually, it's important to segregate the results and look at more bottom up. I believe a few sectors will start showing good results from first quarter itself. For example, private banks, four-wheelers, auto ancillaries, pharma, consumer. Now, all these companies in these sectors will have a evenly spread out, quarter during FY16. Whereas for a few quarters, for a few sectors, the earnings growth may be more back-ended. For example, cement or industrials or telecom or two-wheeler. So, again, I would think that it is not right to say that the entire earnings growth will be back-ended. Similarly, if you look at on the key legislations front, while there is a near-term headwind for key legislations like land bill or the GST, it is likely that it will not get passed in the monsoon session. In fact, now many investors are getting prepared for that. I would think that it is, even if it is delayed by one session or by a couple of months, we have to take that into stride. The market will take that into stride and move on. And maybe the GST implementation could be delayed by 3 months. Instead of 1st April, we could be looking at a 1st July kind of a timeline, which again should be okay from the investor's point of view. Valuations, as you mentioned, I really believe that the valuations are not expensive after the 10% odd correction that we have seen. The market trades at about 16 times 1 year forward, which is slightly above the long-term average of 14.5. For people who are inclined to look at more historical numbers, on a trailing basis, The Nifty trades at about 19 times, which is slightly again above the long-term average of 18 times. Again, not too expensive. So it's a matter of time before the earnings growth pick up, and then in hindsight, the valuations will look much more reasonable.
Okay. Well, Prabodh, do you think there can be, better opportunities to buy? We still don't have a very good clarity on the monsoon. The Met is sticking to its deficient monsoon. So is it that in the near term we are going to get better levels to buy?
Yeah, that's possible. What I said was these are more structural arguments, but of course, if you look at tactically, then it is possible that the market could weaken in the near term. That depends upon many technical factors as well. For example, FI selling. And so therefore, it is possible that, one may get a buying opportunity, slightly lower than current levels in the next 3 months. That is very much possible.
But what is the floor? Is 8,000 the floor like we saw some 4 weeks back?
See, Lata, I would say that yes, the market could have another 5% downside or so. Market could fall more depending upon how, many of these extraneous factors turn out to be, or if there is a bunching of negative news on the domestic front, the market could fall. But then I would think that the bounce back could be equally sharp. So it's instead of, looking at at a floor price, if the market falls, for example, by 8-10%, the bounce back would be very sharp. It is unlikely to sustain at that level for very long. Already we are seeing some buying interest. And one thing which I must point out here is that the very positive thing, in the entire, last 3 or 4 months of correction has been consistent buying by the domestics. That's a very, very big positive from the market point of view. And also gives a big comfort for the FIs that the domestics have been consistently buying, and I think that will provide support. So I would think that as soon as FI selling stops, the domestic buying itself can support the market and stabilize the market.
Okay. One sector that you are optimistic on is the industrial space, Prabodh. And in the last couple of weeks, we've seen names like L&T and BHEL do reasonably well. In fact, as of this morning, CLSA has upgraded BHEL. What do you think is turning in the cycle? And when do you expect the first signs of recovery in earnings to come through?
Yeah, actually, if you look at that's an interesting point. And what I observe is that many capital good and infra companies, their commentary has turned positive. If you look at the fourth quarter management guidance for many of these capital good companies, as well as our interaction with these companies over the last 1 or 2 months, that suggests that majority of capital good companies, the large names that you mentioned and a few others, are all now talking about 2 things. One, they are talking about increased order inflow, and we have seen that the order inflow picking up for a whole lot of capital good companies and road builders and companies in the power T&D segment in the last 3 or 4 weeks. So almost every day or a couple of days we are seeing some new order inflows happening. That is one. And the second is that the companies are indicating that the order execution is picking up. So again, order execution in the industrial space, in the T&D space, in the road space, in the railway space is picking up. So we do expect that many of these capital good companies will show a stronger revenue growth. The margin expansion may be slower. The margin expansion would be more of a FY17 story. But the stronger revenue growth itself would mean that the bottom line growth could be very strong.
Prabodh, before we let you go, a final question. If I were to give you 100 points, how would you sectorally allocate it, on the Nifty stocks?
Okay, you're asking me for my model portfolio. Basically, I'll give you 5 sectors where we are positive, where bulk of the new investment would go. One is private banks. The second is the consumer discretionary space, which includes auto, paints, and miscellaneous companies like tile manufacturers or the adhesive manufacturers, etc. So consumer discretionary. The third sector would be industrials, including capital goods and infra companies. The fourth sector would be cement. And the fifth sector would be IT. These would be the bulk of my portfolio. But then, of course, there would be some allocation towards other sectors like telecom and energy.
All
we
right.
would still continue to avoid PSU banks, utilities, and those two sectors.
Okay.
Okay, Prabodh, we leave it at that. Thank you for joining us and discussing all the stocks and sectors.